Hello students, my name is Gaurav Bansal and we are discussing this series of videos on the Indian economy for the PT 2023. Now, this is a video on the monetary policy. I've already discussed a lot of topics already. Okay, my previous session was on money. I started with microeconomics. In between, I've covered survey, budget, and many other topics. If you want to check out other topics, if you're first time watching this video by me, then maybe you can explore other videos by me on my channel. Now let us start with the discussion without any further delay. So in this topic, we are first going to discuss some of the basic concepts in brief revision mode. I'm not going to explain the concepts. I'm just going to revise them very briefly, and then we will eventually start discussing the PT questions, MCQs. Initially, previous year question. In fact, on this topic, there are so many previous year questions. They cover almost entirety of the subject. Generally, I include PYQ, previous year question, plus other question either prepared by me or some of the good questions I found on internet. But here, perhaps PYQ alone themselves will suffice. Now let us move ahead. So when we study monetary policy, we study that there are certain tools of monetary policy. We divide them in two categories: quantitative tool and qualitative tool. Okay, quantitative and qualitative tool. Quantitative tools which change the quantity of money supply. Okay, we call them general tools because they affect everything in the same way. Do not discriminate between different sectors. Whereas qualitative tools, they are called selective tool. Okay, qualitative are also called selective tools. Quantitative tools are also called general tools because they affect everyone same. They are generally affecting everyone. These can selectively affect a particular section of society. Generally, in PT questions, we have always seen quantitative tools, and that is what I am going to revise. If you want to cover qualitative tools, perhaps I can cover a concept video on that later someday, but not today. Because there has to be a certain time limit. PT is approaching very fast. Student cannot spend too much time on these revision videos also, so I'm trying to keep them short. The first tool is the interest rate. Okay, the interest rates that we talk about here are policy rate. In fact, policy rate. What are the policy rates? The policy rates are, first of all, the bank rate. Okay, then we have repo. Okay, repo rate. We now even call it policy repo rate. Okay. Then after this we have reverse repo rate. We even call it fixed reverse repo rate now. Okay. And then we also have something called variable repo, reverse repo options. This is also something that we have today. Then we also have something called standing deposit facility. Okay, this is introduced very recently. So it is a new concept here. And we also have MSF, marginal standing facility. And this becomes very, very important now because there is a change. There is introduction of new entities here. Okay. So our policy rates system, we used to have a four-fold division. Now there are more systems here. So bank rate, simply the rate at which banks can borrow from RBI. That is the bank rate. Okay. If bank rate is more, banks have to pay more interest to RBI. If bank have to pay more interest, they will charge more interest from common people on their loans. So if these bank rate or any of these rates, they increase, okay, they increase general lending rate. and if general lending rate is going to increase, this will impact the borrowing. Borrowing will reduce. If borrowing will reduce, demand will go down in the economy, investment will go down in the economy. That is the impact, and impact will be same for all of them. But let us move ahead. Policy repo rate. Now bank rate is the rate at which banks can borrow from RBI. In repo, banks again borrow from RBI, but this is not technically borrowing. Here banks sell their securities. Banks have certain securities, some assets, particularly in this case government securities. Now government bonds they sell to RBI, but with a promise to purchase them back at a later date. Okay, so repo, actually the full form of repo today that we use is repurchase. Originally the term was repossession. Both of them have a very similar meaning. Okay, original meaning was, or originally it was repossession. Repossession sounds a bad word. That is why it was replaced with repurchase later on. So you sell something today which belongs to you, but then you repurchase it. Okay, it already belonged to you, so you will repurchase it. Okay, you already purchased it earlier. When you are going to buying it again, you will repurchase it. From there the term repo comes into picture. Repossession is also same. You will take it back, you will repossess, but repossess may indicate use of force also. So repossession sounds a bit harsh term, so it was replaced long ago. Okay, repo comes from here, repossession, but we still use the same repo even if we have made it repurchase. Anyways, the concept is same. You sell a bond to RBI, you get some cash like a loan. Okay, later on when you buy your bond back, you give back the loan, but you pay some interest on that loan. This interest that you pay is determined on the basis of repo rate. Okay, repurchase rate, the rate at which you repurchase your bond. So this is our official policy rate. Repo rate is the official policy rate of the government, through which government indicate everything to the economy, or RBI indicate everything to the economy. So I hope repo is also clear to you. The next is fixed reverse repo rate. So basically we use repo rate and reverse repo rate. The concept is still the same. Even if we call it policy, it is still the same. Okay, fixed reverse repo is also the same. Basically we announce repo rate or reverse repo rate every quarter. The rate that we announce, they are fixed rate, fixed policy rate. But apart from fixed reverse repo rate, from time to time RBI can hold special auction. Okay, RBI can introduce special scheme at variable repo. Okay, variable reverse repo. Since there can be variable reverse repo, this original is called fix. This is a new thing, so very recently I've started using this fix. So there are a lot of changes here. Originally we did not use the term policy. Originally we did not use the term fix. Okay, variable is a new term here. So I will explain these more in the current affairs also, but very briefly, there are two types of repo auction. One on the basis of the rate which is defined in the monetary policy, that is the fixed rate. So any bank can sell anytime or buy anytime, okay, accordingly. But there are some special auction also. Okay, so there is no fixed rate here. So this is not a policy rate actually, because this is nowhere mentioned. Okay, ये होता ही नहीं है. This is decided on the basis of auction. So that is why there is no fixed rate here. All of these basically are fixed for the quarter, but this is not. So since these are there, we also have fixed reverse repo. Basically this is not even part of this list. I mention it here so that this term is covered. Okay, since it is variable and since it is auction, it is not a fixed rate. Okay, for repo also there can also be an auction. That will also be a separate thing. Okay, that is why policy repo rate, which is also the fixed repo rate. Standing deposit facility. Standing deposit facility is absolutely new type of tool. Basically when banks have extra cash, they can deposit it with RBI and get interest. So that is standing deposit facility. Okay, it was not, when it was not introduced, when we were waiting for it, okay, in fact in all my batches last year I told students that very soon there will be new system, standing deposit facility. Now when it is finally introduced, we can talk about it. We were expecting that this will be the lowest interest rate, but this is not true. The lowest interest rate is still the fixed reverse repo rate. Just give me 1 second please. The lowest rate is the fixed reverse repo rate. This is not the lowest. And then we have a marginal standing facility. This is for one night loan. Okay. This is also a borrowing facility for from RBI. It is very much like repo. This is a one night repo, means you can borrow today, you have to repay tomorrow. Okay, you sell your bond, you get money against it. Next day, you will repurchase your bond and give back the money. So this is a very short term, almost marginal, okay, very immediate. Next, this is the marginal system. So these are the different policy rates that we have, or the interest rates that RBI has. I hope I've covered it. I will again talk about variable auctions, okay, in the current affairs, and also the standing deposit facilities. Now I'm removing this and we'll move ahead. So with policy rates being covered, now let us move ahead with the reserve ratio. Reserve ratio are basically the CRR and SLR. The cash reserve ratio are statutory, means necessary, compulsory. Liquidity ratio means this much amount of funds must be in liquid form, which can be easily converted into cash. Liquidity I discussed in the previous video. If you are not aware of what is liquidity, please watch the previous video. That anyways is very important for students. So statutory liquidity ratio, necessary liquidity that banks have to maintain. So bank has given 100 rupees as a loan. Okay. Now the rule at present is that out of these 100, almost 18-19 rupees you should keep in a liquid form, in the form of the government bonds or other securities. So these you can sell. A bank can trade them and get cash. If there is emergency, bank can do that. For example, bank has given loans. Okay, I have taken a home loan from bank. Bank cannot come to me and say, sir, we are in emergency need. So what you do? आपने जो home loan लिया ना 20 साल का, वो आज ही सारा वापस कर दो. You have taken a home loan for 20 years. What you do? You give all of this back today. This can't happen. So bank can't ask people to pay their loans immediately. So when bank is in emergency need for money, it can sell those bonds. So bank have to keep some money as bond. And even before that, there is a necessary cash. Okay, usually 3 to 4% or sometimes even 4.5%. Banks have to keep as pure cash with RBI. They do not even get interest on this. If they have any difficulty, this is the necessary and the first liquidity that they have, and this is the secondary liquidity that banks have. So both of these provide liquidity in the system and they prevent from the bank run. This is the role of reserve ratio. Particularly CRR is for bank run. What is bank run? Bank running out of cash. Okay, suppose people want to withdraw cash. I have bank deposit, I want to withdraw, but bank says, sir, हमारे पास आज पैसा नहीं है, आप 2 दिन बाद आना. We do not have cash right now, you come after 2 days. That's not the way bank can treat its customer. Bank needs to have all the cash. If it has a shortage of cash, it can ask RBI from its reserves. So that is its reserve kept for emergency needs. If still this doesn't work, usually this should work. If this doesn't work, even these can be sold. So this is the support liquidity. On this bank earn interest, on this bank do not earn interest. So this is the summary of the reserve ratio. The point is, if reserve ratios are more, more amount of cash will go out of market. Means this much amount of money, roughly 22-23% of the cash in the market will not be available. This will be outside. This decreases the money supply. Okay, if reserve ratios increase, the money supply decrease. Okay, that is how we can define this. And then we have OMO, open market operations. In open market operation, RBI sell or buy bond. Okay. Now, when RBI sell bond, what will happen? Bonds go to bank, and cash comes to RBI. So what happens? Money supply decrease. When RBI sell bond, money supply decrease. Similarly, when RBI purchase bond, bond come to RBI, cash go to bank, money supply increase. So when RBI has to increase money supply, it purchase bonds. When RBI has to decrease money supply, it sell the bonds. So that is OMO. OMO is also used for maintenance of exchange rate. But when we use it for exchange rate, we call this process sterilization. It is the same process of OMO. Here we sell the forex, okay, the foreign currency reserves or the foreign currency denominated bonds. So then it is the same process, but we call it sterilization. So these are the different tools of monetary policy. Impact of monetary policy. Now, we have seen here for the case of reserve ratio and OMO. For interest rate, I already discussed. If interest rate increase, money supply decrease. Simply. Okay, and when interest rate fall, money supply fall. Sorry, just 1 minute please. Money supply increase. I accidentally said this. Money supply increase. Now, we have discussed what happens when we tweak this, but what happens when money supply changes? Now let us move ahead. We have discussed the impact of these tools on money supply, but what happens because of money supply? If money supply is more, then interest rate falls, or if interest rate fall, money supply increase. Okay, so they both lead to each other. And when any of these happen, okay, because they both lead to each other, they fulfill each other. So when any of these happen, the companies find it easy to take loan, people find it easy to take loan, and when we can take loan easily, the demand increase. Investment increase. Okay, now I will clear it and I will restart the discussion. Now, what is the impact of these tools on monetary policy? We have discussed. When money supply increase, interest fall, and they lead to each other basically. Now, any of these happens, this will lead to demand increase and investment increase. And when investment and demand increase, what will happen? This will lead to more growth. Basically, demand, if it rises, it also encourages investment. And basically, through investment, growth rises. We can, in fact, demand directly doesn't affect in growth, it affects the growth through investment. So that way you can better understand it. Basically, demand increase, it will lead to growth, but through this step. Okay. And what is the other impact of increase in demand? This is the price rise from basic microeconomics. If supply is same and demand increase, what will happen? Prices will rise. So when we cut the interest rate or increase the money supply, there are two outcomes. There is improvement in growth, but at the same time there is also inflation. So that is why we always have to be careful with our monetary policy. That is why it is tough, because we want to achieve growth, but we do not want to have inflation. So we have to maintain a balance. So that is the challenge of monetary policy. Now in India, the monetary policy is quite clear. Inflation is the primary responsibility. If inflation is under control, then we take care of growth. So that is how monetary policy works. And with that being discussed, we will now move to the questions. Question number 1. The lowering of bank rate by RBI. You do not have to bother with any specific rate. Fall in any of the rate leads to same outcome. Okay, any interest rate works the same way. Okay. So whether it is bank rate, repo rate, should not bother you. Lowering of the rate, in fact, all of them go down together. When you do not decrease one of them specifically, all of them usually go down. So lowering of bank rate, basically interest rate by RBI, will lead to, we have already discussed, bank rate or interest rate go down, money supply increase. More liquidity in the market, which is correct. Less liquidity in the market, which is wrong. No change is also wrong. Mobilization of more deposit is also, basically it's more complex. Okay, A is already a better statement than this. So even this is also wrong, because okay, mobilization of more deposit, when interest rate fall, people do not want to deposit much. A is correct answer. More liquidity in the macroeconomics. In the microeconomics, liquidity is how easily you can convert an asset into cash or other asset. And in macro, how much how much overall money in the financial system is available as surplus. The difference between the money supply, okay, excess of loanable funds over the demand for funds. This gap, this excess of supply is known as the liquidity available in the market. If money supply increase, liquidity will rise, simply. Second, a rapid increase in the rate of inflation is sometimes attributed to as base effect. Okay, what is the base effect? Base effect is used in many cases. Okay, it is used for GDP also. Basically, when we have intertemporal data, intertemporal means over the years, and we talk about percentage, sometimes these percentage can be deceiving. Okay, for example, last year my income growth was negative. Let us say, for example, generally India has 7% growth rate, but for 1 year in between, let us say because of COVID, we had -1% growth. Means rather than growing, we went down. Next year, if we have 8% growth, this is not something very extraordinary, because already we had a very bad year previously. So things were likely to accelerate very fast, okay, because there was already a lot of pent-up demand. There was already a lot of people who were basically postponing their purchases because of bad time. They were ready to buy more. Okay, economy was likely to come off after the shock. So this is a good performance. I'm not saying you should not take away anything from this economy. It's an excellent performance, but it is still very much in the trend of this 7%. Okay. The excellent part is that economy has recovered quickly, but you can't say this growth is too much higher than the previous growth. Similarly, if previously last year we grew at 15%, next year it is very difficult to rise very fast, because last year already we grew very fast. Now the base itself is high. Let us say in a company there are two employees. One has income of 1 lakh, another person has income of 30,000. Both are given percentage increment. Both are given 20% increment. The person who has 30,000 income will get 6,000 rupees increment, and the person who has 1 lakh rupee income will get 20,000 rupees increment. Increment is same for both, but the base of the first person with 1 lakh income is more. That is why that person is benefiting more. So that is how base effect work. Now, let us look at the option. It is the impact of the drastic deficiency in supply due to failure of crops. No, it is not related to failure of crops generally. Okay. It is the impact of the surge in demand due to rapid economic growth. Now the context here is inflation. Okay, so no, not that one. This B is actually not related to this phenomena. C, it is the impact of price levels of previous year on the calculation of inflation rate. That is correct. Okay, already if last year we had 20% inflation and we have 10% inflation this year, we can't say that inflation is falling very fast because already we had very high price rise last year. So already the prices which should have been, let us say something was available for 200 rupees. Last year its price became 240. This year again the price rise by 10%. Now it is 10% of 24. Price will rise by 254. Okay. Whereas if last year there was no inflation, 10% inflation would mean price rising by 10 rupees. Okay, or sorry, 20 rupees at 10%. Yeah, 264. Okay, so because last year also we had inflation, because of the last year inflation and higher price level, the same percentage effect has more pinch. So that's what we have. Next, which of the following measure would result in an increase in the money supply in the economy? Okay, purchase of government security from the public by the central bank. If RBI buy the bonds, okay, from public or from banks, what will happen? RBI get the bond, public get the cash. Okay, this increase the money supply. Deposit of currency in commercial banks by the public, this will also increase the money supply because this will increase the money multiplier. There is a very important concept of money multiplier. Three, borrowing by the government from the central bank. If government borrow money from central bank, even this will also increase money supply. Okay. This is not allowed in India, by the way, but still, if government borrow from RBI, not through RBI, then RBI will print more currency and give it to government. And that way, there will be more cash into the system. Sale of government security to the public by the central bank. Okay, this will not increase the money supply. Money will shift from public to government. So, okay, now this particularly 2 we have to check out. It looks correct in the first go, but if we review the situation, deposit of currency in the commercial banks by the public, then basically it will change the money supply in the future, but will not result increase immediately. Okay, if we had an option 1, 2, 3, I actually would choose 1, 2 and 3 because question doesn't clearly say immediately or not. Question simply say increase in money supply. So 2 will definitely increase the money multiplier. Less cash preference increases money multiplier. This is the very theory in economics. Money multiplier increases when reserve ratio fall down and people have less preference for cash. So money multiplier increase means overall money supply should increase, but immediately money supply will not increase. Immediately simply currency with public will decrease and bank deposit will increase. So it will just create a readjustment. Since we do not have 1, 2, 3 as an option, we can choose 1 and 3 here. Okay, so C will be the answer. So sometimes even an option which looks to be correct, we may have to reject it. Okay, here it looked correct because context is missing. So sometimes it depends upon luck also. because the examiner was thinking from a certain frame of mind. So he or she defined in a certain way, but didn't give that context from which they were thinking in the question. Every year 1 or 2 questions like that come, and then it is up to interpretation whether you include that factor or not. Question number 4. An increase in the bank rate generally indicate that. Okay. Very similar to the previous question. Lowering of bank rate. Okay, that was in 2011. Very similar question in 13. In fact, even today, questions like this are coming. So this is very important topic. Increase in the bank rate. If interest rate go up, money supply go down. Okay. And interest rate increase. Now let us look at the option. Market rate of interest is likely to fall. No, it is likely to increase. Central bank is no longer making loans to commercial banks. No, not related. Central bank is following an easy money policy. Easy money policy is when we are leading to increase in money supply. Okay, money is not easily available. This is also not happening. This is not happening. Central bank is following tight monetary policy. This is correct. When money supply falls, this is a tight monetary policy. Which one of the following is most inflationary? Okay. Repayment of public debt. Okay, we have to compare between the 4, so we have to read all 4 here. Borrowing from the public to finance a budget deficit. Borrowing from banks to finance a budget deficit. Creating new money to finance a budget deficit. So basically, whatever will create the maximum money supply will be the maximum inflation, will create the maximum inflation. Repayment of public debt. Government has taken debt from public and government repay it. So money go from government to public or banks. Okay, that is readjustment of money. Not much impact on money supply. Borrowing from public to finance budget deficit, again not much of impact. Borrowing from banks to finance a budget deficit, bit of an impact, but creating new money to finance a budget deficit, this is going to have maximum impact, because here we are adding completely new source of money supply. Here we are adjusting between the existing, but here we are adding. So this is always the most inflationary. Okay, and in India we do not allow it. This is not permitted as per FRBM Act. Okay, this is called deficit monetization, and in FRBM Act this is not permitted. So the answer is D. 6th, supply of money remaining the same when there is an increase in demand for money. There will be, if supply is same and there is increase in demand, forget about money, simply in demand and supply, if supply remains same, demand increase, price rise. Here it is the interest which get affected. Okay, interest rate rise. Let us look at option. A fall in the level of prices. Okay, we have to look at other options also. An increase in the rate of interest. This should happen. Decrease in the rate of interest. Should not happen. An increase in the level of income and employment. Okay, not much. Okay, it is B already is there, and B is already a much better answer, so we should already opt for it. If there was no B, we could have thought for A, D, okay, as a possibility. You do not have to work out, because out of all the answers, if there is an easiest answer, straightforward answer, choose that. Okay, which uses the minimum condition. If the interest rate is decreased in an economy, it will, okay, if interest rate goes down, what will happen? If interest rate go down, we have discussed it increase demand and investment. Now let us look at the options. Decrease the consumption expenditure. This is wrong. Increase the tax collection of the government, possibly, because demand will rise, so taxation should rise. Increase in the investment expenditure in the economy. C is correct. Okay, C is the correct answer. We could have thought of other things if there was no C, but already C is there. 8th, which one of the following is not the most likely measure of RBI to stop the slide of Indian rupee? If RBI wants to prevent the depreciation, then what is not likely to happen? Okay, so curbing import of non-essential goods and promoting exports. Curbing import of non-essential goods, it will help. Yes, it will reduce the import and improve the trade balance and may improve the condition of rupee. Promoting exports will also do that. So one is a likely measure. We have to choose non-likely measure. Okay, so A is not the answer. We have to find out incorrect. Encouraging Indian borrowers to issue rupee denominated masala bond. Okay, if Indian borrower, people who are borrowing in India, they issue masala bonds, means their international loans are denominated in rupee. That is going to have what kind of impact? With that, we will not be affected much by exchange rate. So that is also going to improve actually. Whatever international loan that we take, we should take it in form of rupee, means we will pay you in rupee terms, not in dollar terms. Means we take loan in rupee. We may take dollar from you, but let me define. I want to take a loan of 1 crore rupee. Okay, I define, okay, 1 crore dollar, let us say. So I define them that this is denominated in rupee. Today exchange rate is, let us say, 80. So this is equal to 80 crore rupee. According to the agreement, we will pay you 100 crore rupee after 2 years or 3 years. After 3 years, we'll pay you 100 crore rupee. Meanwhile, exchange rate can change. You are not bothered by that. Whatever is the value of 100 crore rupee, then in dollar, you will pay that. So that is masala bond. Masala bond is rupee denominated. Easing conditions, in fact, it is very clearly given. Okay, easing condition related to external commercial borrowing. If there is more borrowing from outside and more dollars are coming, that may also improve rupee immediately right now. Okay, so this is not as good as the first two, but still that is okay. Following an expansionary monetary policy. If we follow expansionary monetary policy in India, we will have inflation, and that will lead to even further slide of rupee. Okay, inflation increases the depreciation. So D is the least likely. D is the answer here. We should not be doing that at that time. For example, in 2022 it happened. When US Fed increased the interest rates or the Fed rate, then RBI had to follow a tight monetary policy. It had to increase interest rates in India. Next question, if the RBI decides to adopt an expansionary monetary policy, which of the following it will not do? Okay, very similar question. If they want to increase money supply, what they are not going to do? Any option which decreases the money supply. Cut and optimize the SLR. If they cut the SLR, it will create more funds. Okay, we have discussed that. SLR, CRR, if you increase, money supply go down. But if you decrease them, money supply go up. Cut and optimize. So this will increase money supply. So it should do it. Okay. Second, increasing the MSF rate. Basically, any interest rate you increase, it will decrease the money supply. So this is what it is not likely to do. B is one of those. Cut the bank rate and repo rate. This will also increase money supply. So this is also not among that it will not do. So B, 2 only should the answer for 9. Okay, we had to find out options which decrease the money supply, second increase the money supply. 10th, in India, central banks function as the lender of last resort, usually refers to which of the following? It is simply a concept here. So in this case, lending to trade and industry body when they fail to borrow from other sources. This is in, just give me 1 second. This is incorrect because it is not for trade and industry body. When they fail to borrow from other sources, could have been correct part. So Second, providing liquidity to the bank having a temporary crisis. This is correct. Okay, so when no other function is available, they can give them some extra credit. Lender of last resort means when nothing else is there, then I am there for you. Okay, like God. Okay, so likewise. Third, lending to government to finance budgetary deficit, not at all. So second, two only. Okay, B is the answer for 10th. This is all of these are previous year question. We already have a lot of previous year question here, so there is no need for other questions. With reference to Indian economy, demand pull inflation can be caused or increased by which of the following? Demand pull inflation can be caused by any policy which increases demand simply. And what increase demand? When money supply increase, interest rate go down. Okay, expansionary policy increase demand. This is correct. Second, fiscal stimulus. This is also similar to expansionary policy. Okay, by this also you increase the demand. Third, inflation indexing wages. This is not related. Higher purchasing power. Any tool which will increase people's income, higher purchasing power, that will also create demand pull inflation. So that will also lead to this. Rising interest rate, not at all. Okay, this will decrease the demand. Third is not related, fifth is wrong. Answer should be A, 1, 2 and 4. 12th, Indian government bond yield are influenced by which of the following? Our bond have to offer what interest depends upon the international bond prices also, because there are a lot of international buyers as well. So we have to keep in mind what other countries are offering. So yes, one is there included. Action of the Reserve Bank of India, of course this affects the, okay, so this definitely affects the interest rates or the bond yields. Inflation definitely affects, and short-term interest rate definitely affect. Everything here affects the bond yields. So in this case, D, 1, 2 and 3 shall be the answer. Last question in this session. With reference to the Indian economy, what are the advantages of inflation indexed bonds? IIBs. Now, what are inflation index bond? That if there is inflation, these bonds will pay you at least that much interest. Okay, let us say bond promise 5% interest, but inflation is 11%. Bond had promised you 5, but when inflation is 11, then bond will pay you this rate of interest. Either 5 if inflation is more than inflation rate. This is what we mean by inflation index bond. Now, regarding this, let us look at the statement. Government can reduce the coupon rate on its borrowing by the way of IIB. That is correct. Coupon rate is the rate which government offer as a fixed rate on the bond. If government is giving inflation indexing, this rate can already be lower, because this bond is already attractive because of inflation indexing. Compared to other bond, you can offer lesser interest. One is correct. Second, IIB means inflation index board provide protection to the investor from uncertainty regarding inflation. This is definitely correct. This is the very definition. Third, the interest received as well as the capital gains on IIB are not taxable. This is wrong, of course. This is wrong. Everything is taxable. Okay. Interest income is your factor income, and that is very much taxable. Answer should be A, 1 and 2 here. So I hope this session has helped you and has given you a good quick revision. And if you think this video has contributed to your preparation, has helped you with the concepts, kindly share it. Okay, kindly give it a push, because that will be your contribution to me if you feel I have contributed to you. Okay, it's a very small channel. Your contribution, your shares, your likes, your comments in fact also go a long way, because they improve the validity of these videos. If you comment a lot, YouTube will find that a lot of people are engaging with this video, and YouTube promotes engaging videos. So kindly comment also. Okay, so thank you.